Ever wondered if you, an everyday person, could actually beat the pros on Wall Street? I mean, really beat them. Peter Lynch, one of the greatest investors of all time, gives a resounding yes. And not just squeak by, but potentially achieve phenomenal returns. In the next few minutes, we're going to dive deep into his legendary book, One Up on Wall Street, to uncover his surprisingly simple yet incredibly powerful strategies. These are the secrets that have turned ordinary investors, people just like you and me, into millionaires. It's time to stop listening to all the confusing noise from financial news and start looking for the gold that's right under your nose. This isn't about complex formulas or risky day trading. This is about common sense wealth building, and you're about to find out how to master it. So, who is Peter Lynch? Imagine this. From 1977 to 1990, he ran the Fidelity Magellan Fund. During his 13-year tenure, the fund's assets grew from a modest $80 million to an astounding $14 billion. What's even more mind-blowing is his average annual return of 29.2%. $1,000 invested with him at the beginning would have turned into over $28,000 by the end. He didn't achieve this with some secret algorithm or inside information. He did it by applying a philosophy that he passionately believes any amateur investor can use. His core message is liberating. Your greatest advantage in investing isn't a finance degree from an Ivy League school. It's what you already know from your everyday life. Lynch calls this local knowledge. Think about it. Wall Street analysts are sitting in their offices in New York, buried under spreadsheets and financial reports. They're trying to understand dozens, if not hundreds, of companies at once. But you're out in the real world. You see which restaurants always have a long line. You notice which new clothing brand all the kids are suddenly wearing. You work in an industry and know which company has the best product, the happiest employees, and the most incompetent management. This first-hand experience is your secret weapon. It's an edge that no Wall Street pro can replicate. Let's break down how this works in practice. Lynch famously tells the story of how he discovered Hanes, the company behind Legs Pantyhose. It wasn't through a complex market analysis. His wife, Carolyn, came home from the grocery store and told him how amazing these new pantyhose were. They were affordable, durable, and conveniently sold right there in the supermarket. She loved them, and her friends loved them. Lynch did some digging, realized the company was onto something huge, invested, and it became one of his most successful picks, what he calls a 10-bagger, an investment that goes up 10 times its original value. The initial signal didn't come from a stock ticker. It came from a shopping trip. This leads to Lynch's first big rule. Invest in what you know. This is so simple, yet so profound. If you're a doctor, you have a unique insight into medical device, companies, or pharmaceutical breakthroughs. If you're a software engineer, you know which tech companies are creating genuinely innovative products versus those that are just hype. If you work in construction, you know which materials, suppliers are reliable and always busy. Don't discard this knowledge. Before you even look at a company's stock price, you should be able to explain, in simple terms, what the company does and why it's going to succeed. If you can't explain it to a fifth grader, you probably shouldn't be investing in it. This simple test cuts through so much of the noise and forces you to focus on businesses you truly understand. But just knowing a company isn't enough. You still have to do your homework. This is where the amateur can't get lazy. Your local knowledge gets you to the starting line, but you need to do some basic research to see if the company is financially sound. Lynch isn't asking you to become a certified accountant. He's asking you to look at a few key things. First, check out the company's balance sheet. Is it carrying a lot of debt? Companies with little to no debt are much safer bets because they won't go bankrupt during a tough economic downturn. He calls a strong balance sheet the ultimate protection. Next, look at earnings. Are they consistently growing? You don't want a company whose profits are all over the place. Steady, predictable earnings growth is a beautiful thing. You can find this information easily in a company's annual report, which is usually available for free on their websites in the investor relations section. Don't be intimidated by these reports. Lynch encourages you to skip the glossy photos and jargon-filled letters from the CEO and go straight to the numbers. Look at the revenue, the net income, and the earnings per share over the last 5 to 10 years. Is there a clear upward trend? That's a great sign. 4 legs, The story was about revolutionizing how women buy pantyhose. For a tech company, it might be about a new software that will change an entire industry. Your job as an investor is to figure out the story and then monitor it. Is the story still playing out as you expected? Are they opening new stores as planned? Is that new product selling as well as you thought it would? If the story starts to fall apart. For example, if a competitor comes out with a better product, that might be a signal to sell. Investing isn't a set-it-and-forget-it game. It requires you to stay engaged with the companies you own. Now, let's talk about the different types of companies. Lynch brilliantly categorizes stocks into 6 distinct groups, and understanding these categories helps you know what to expect from your investment. First, you have the slow growers. These are large, established companies that grow just a little faster than the overall economy. Think of big utility companies. They pay a reliable dividend, but their stock price isn't going to explode. They're safe, but not exciting. Then you have the stalwarts. These are giants like Coca-Cola or Procter & Gamble. They are not growing at lightning speed, but they offer consistent, moderate growth. Lynch saw these as great protectors in a portfolio. A 30 to 50% gain from a stalwart is a solid win, and they're less likely to crash during a recession. Next are the fast growers, and this is where the real excitement is. These are small, aggressive new companies that are growing at 20 to 25% a year. This is where you can find those 10 beggars. But Warne, they are also riskier. For every fast grower that succeeds, many others fail. This is where your industry knowledge is most critical. Then we have the cyclicals. These are companies whose sales and profits rise and fall in a somewhat predictable cycle. Think of airlines, car manufacturers, and steel companies. When the economy is booming, they do great. When a recession hits, they get hammered. The key here is timing. You have to buy them at the bottom of the cycle and sell them at the top, which is much easier said than done. Fifth are the turnarounds. These are companies that have been beaten down and are on the brink of disaster, but have a chance to recover. Think of a company like Chrysler in the 1980s. If you can correctly identify a company that's about to turn its fortunes around, you can make a massive profit, but it's extremely high risk, as many turnarounds never actually turn. Finally, you have the asset plays. These are companies that have some valuable assets that the market is overlooking. It could be a pile of cash, real estate, or even a patent portfolio. The idea is that the value of the asset is worth more than the company's total stock market value. These are hidden gems, but they require a bit more detective work to uncover. By categorizing your stocks, you know what to expect, and you can build a balanced portfolio. You don't want a portfolio full of only risky fast growers, nor do you want one composed entirely of slow growers. One of the most important lessons from Lynch is about psychology. The stock market is an emotional roller coaster. People get greedy when prices are high and fearful when prices are low. The amateur investor's biggest enemy is often themselves. Lynch's advice: ignore the noise. Don't panic sell during a market crash. In fact, he sees market corrections as golden buying opportunities, a chance to buy great companies on sale. He famously said, "The real key to making money in stocks is not to get scared out of them. If you've done your homework, you understand the company, you believe in its story, and its financials are strong, then a drop in the stock price is just a temporary event. Have the courage of your convictions." Think about it this way. If you owned a successful local pizza shop and the stock market crashed, would you immediately sell your business for half of what it's worth? Of course not. You know it's a good business that'll continue to make money. You should treat your stocks the same way as ownership in real businesses, not just as blinking lights on a screen. So, let's put it all together. How do you, starting today, apply the Peter Lynch method? Step 1. Start looking for potential investments in your own life. What products do you love? What services can't you live without? What company does your brew-in-law, the mechanic, rave about? Make a list. Step 2. Pick one company from your list. Go to their website. Can you explain what they do in 2 minutes? If yes, proceed. If no, move on to the next one. Step 3. Do the 10-minute research drill. Find their investor relations page. Look at their annual report. Is debt low? Are earnings going up? Don't get lost in the details. Just look for the overall trend. Step 4. What's the story? Why will this company be worth more in 5 or 10 years? What category does it fall into? A fast grower, a stalwart? Step 5. If everything looks good, consider making a small investment. Lynch was a big advocate of diversifying, so don't put all your money into one stock. But by starting with one, you learn the process. The beauty of Peter Lynch's philosophy is its accessibility. It demystifies the stock market and empowers the individual. You don't need a fancy terminal or an expensive subscription to a data service. You need curiosity, a little bit of homework, and the patience to let your great companies grow. Wall Street has to chase short-term performance every quarter. You don't. You can afford to be patient and wait for a tin-bagger to unfold over several years. That is your ultimate, unassailable edge. So the next time you're at the mall, the grocery store, or even just talking with friends, keep your eyes and ears open. Your next great investment idea might be right in front of you, waiting to be discovered. That's the power of having one up on Wall Street. Thanks for watching today. I hope this gave you a new perspective on investing and made you feel more confident about your ability to build wealth. If you found this video helpful, please hit that like button and subscribe for more deep dives into the world's best financial books. Let me know in the comments if you've ever discovered a great company in your daily life. See you in the next video.